A hedge fund is a pool of private capital that's been established by investors largely in order to be able to sidestep the constraints that are imposed on portfolios of public investment vehicles like mutual funds. The first of these kinds of organizations first surfaced in 1950. It was created by manager Alfred Jones, who ultimately decided to try to build a low-risk investment vehicle by both shorting and going long at the same time. Ultimately, by buying and selling company or shares of companies that were in similar industries, he hoped to hedge out not just some of his market risk, but also to hedge out individual industry factors, allowing him to focus entirely on the idiosyncratic gains of one company versus another within a particular sector. Now, this is generally a low yielding strategy, but it is one that can provide absolute returns whether markets are up or down. And with sufficient amounts of leverage, this strategy can be remarkably profitable. Now, in terms of profitability, Jones's fund did miraculously well. From 1960 to 1965, he made a compound return of 325%, beating the best mutual fund available at the time by a full 100% over the same 5-year period. Looking at a longer decade-long period from 1955 to 65, its performance was 670%. Now, falling back to ancient Phoenician tradition, Jones said that he would only charge 20% of profits that were earned by the fund, but would charge no fees if there were any kinds of losses. And this sort of idea of charging a 20% premium actually dates back several thousand years, as this student of history thought it might be poetic to describe similar kinds of risky ventures with a familiar sort of fund fee structure. Now, because hedge funds are generally closed to the public, they're able to follow a lot more aggressive and unusual investment strategies than what we might typically see in an open-ended mutual fund. This can include the long-short strategy that was just discussed. There are event-driven strategies trying to take advantage of mergers or specific macroeconomic events. There are those focused on purchasing distressed securities and trying to make them more marketable. There are those focused on statistical merger or convertible arbitrage. Effectively, for a hedge fund, the sky is the limit. There aren't really any constraints over what a private pool of capital can invest in. Ultimately, though, the positions that they invest in aren't usually particularly liquid. And as a result, hedge funds tend to maintain lockup periods of anywhere from 2 to 3 years compared to mutual funds, which would allow you to redeem or buy new units from the fund on a daily basis. Hedge funds, instead, will tend to keep the capital that they've been awarded locked up for periods of several years, enabling them to take several long shot bets that might take time to ultimately play out. Now, these types of pools are notoriously secretive about their precise methods and strategies. And in general, they're not required to disclose to their investors, except in the vaguest terms, exactly what it is that they're going to do with the money. Now, while this might seem simply extraordinarily risky for investors to part with their funds with such little transparency, it's worth noting that the so-called golden age of hedge funds from about the mid-1970s until the mid-1990s saw some truly spectacular rates of return from some of the best investment minds that we have in the world. Now, these returns listed on this slide do not include any of the fees that were being charged by these managers you see here along the top row. But from left to right, we have Victor Niederhofer of Niederhofer Investments. Between 1980 and 1996, he earned a total compound return of approximately 12,000%, or roughly 35% per year, net of all fees, afterward fees. Julian Robertson here of Tiger Management, between 1980 and 1989, a longer period in time, but he averaged about 13,700% over that entire period, or roughly 31.5% a year. Famous darling of conspiracy theorists, the internet over, George Soros, his quantum fund ran from 1973 to 1989 and earned a compound return of 6,500%, or roughly 30% a year after fees. And finally, Mike Steinhardt of Steinhardt Partners on the far right was active from 1968 through 1995, earning a total return of 33,000%, or roughly 24% per year. However, the undisputed titan of the hedge fund industry is Renaissance Technologies, a fund established by quantum physicist who retired from MIT, Jim Simmons, back in 1978. Now, their fund in particular has focused on a number of different kinds of techniques for analyzing markets. And in particular, what they've done is staffed the organization with dozens of scientists from fields ranging from linguistics to cryptography in an effort to decode markets in a way that wasn't being taught in business schools. At best, the Renaissance team argues that the managers who are of leading Wall Street firms that are educated in business schools are all thinking about problems in the same way because they all went to the same schools. And Rentech effectively decided to rewrite the book on investing and takes a completely different approach to management of their fund. And as a result, Rentech has been remarkably successful. Their medallion fund has averaged a return of 40.5% every year since its inception in 1988, despite charging the highest fees in the industry. Whereas Alfred Jones had charged 22% of any gains and nothing if there were losses, Medallion charges 5% of assets under management, win or lose, as well as 44% of all gains. Nonetheless, after fees, we're looking at a total compound return since 1988, roughly, of approximately 5 million%. Now, the Medallion Fund has been closed to outsiders since 1993 and is now entirely owned by its employees, but it remains one of the very best performing hedge funds in the world. There is no asset pool that comes even close to the consistency and returns that Renaissance earns with its Medallion Fund.